Good morning, everyone. Some time ago, Mr. James Alexander was also attending a lecture like you are now in this same institution, and we are really fortunate to have him today because not only he's going to share with us his knowledge about corporate America and its intricacies, but he's also going to share with us his experience in the banking industry. And we as philosophers love wisdom. We want to look for the truth. We have inquisitive minds. And we aspire to have a sound ethical judgment with a solid moral compass. And here we have an example of the best that our alma mater has produced. So join me in welcoming Mr. James Alexander, who is going to teach us many things, and particularly how really corporate America works outside academia. Many of you are going to be there, and believe me, you want to know what is really going on. Thank you very much, Jim, for coming.
Thank you for that generous introduction. I'm here today to talk about three things. Two of them are fairly easy to discuss, and that's how diseased the culture was at Enron and how healthy the culture was in my last job at Spinnaker Exploration, which were diametric opposites in many ways, both ethically and economically. More difficult, and it really deserves a lot more time. It's not exactly a seamless web, but it's a web with many strands. Was what happened to the ethical culture of U.S. public companies in the last quarter of the 20th century, and how Enron was the predictable outcome of those changes. And I believe actually Enron was also the precursor of the problems in the financial crisis. So it really represents a pivotal spot in the history of American corporations in the last 50 years. We'll see how I do with the sea change part. I'm going to try to give you a feel for it. I had to truncate a much longer presentation to try to give you the right impression without being able to give you a full explication of all that happened. We'll see. The first question I think you should ask yourself of anyone who's speaking is, why do they really have any plausible claim to know anything? And I think I was uniquely well positioned to be able to know what the culture was up through about 75 after World War II, the corporate culture, the way it changed in 1975 to 2000, and how that led to the changes in the financial crisis. Certainly in the post-World War II era, between my father, who was a top corporate tax lawyer, my uncle, who was a top aviation executive, and my godfather was a top telecom executive, I think I had a view of the mindset of the people who are running major public companies, certainly up through the mid-70s. Mid-70s on, I was exposed to what was going on both directly and indirectly through my checkered investment banking career and through being the CFO of a couple of different energy companies. As to Enron specifically, I was there at its creation and there up to the mid-90s, where I was helping the pre-Andy Fastow CFO deal with bankers, and then was the CFO of one of their spin-offs. Not trying to prejudice people about what I'm about to say next, but one of my favorite cartoons. There was a complete sea change in the culture of U.S. public companies between the 70s and the 90s. The 70s, I think in combination, really a reflection of the broader attitudes of society, was extremely group-oriented. Some of the orientations were extremely beneficial, some not, at least in point of view of profit maximization. So whether it was authority or traditions or the importance of cooperating or responsibilities to the group, generally the individual tended to defer to the group, quote, wisdom, unquote. Government was generally viewed as a force for good, and ethics was, a strong sense of ethics was vital to any successful business or career. There are always exceptions to any type of social structure, but this really predominated in my experience early on and the experience that my family cited as what drove a lot of the people they knew. By the 90s, this old ideology had not only been eroded, it had been reversed, where it's self-evident that responsibilities to the self always trump those to the group. And group and hierarchy emphases lead to nothing but mediocrity. The old ethical rigidities have been replaced by a much more sophisticated risk-return analysis, and the outmoded concerns that might have been represented by religion were admirably displaced by game theories. And also, by the way, whenever I tend to lapse into sarcasm, which is never a good idea for anybody. So whenever I'm expressing admiration for something, you can assume the reverse. It's just when I start thinking about what happened, basically all the certainties that were there at the start were reversed by the end, and you start to wait and hope that things will reverse again because of what's going on today. Finally, government regulation, instead of being generally a force for good, was self-evidently harmful, and that the private sector solutions are always best. You know, with any huge change, it's hard to trace where does it all start. I'll give you what my theory would be, and in the case of at least corporate culture, and that is, in the mid-1980s, high-yield bond finance, hostile takeovers began in it. And if you were a CEO prior to the development of credible threats from independent raiders, you were basically king of a kingdom. Now, you were obliged to be good to your subjects, but you were the king. You were unassailable. And especially with a fairly zealous Department of Justice and FTC, your competitors were not going to be able to go after you, usually because of concerns over antitrust. So you were immune. You were the king. But when hostile raiders using high-yield bonds start being able to destabilize solid old corporations, all of a sudden the thought starts to occur to you that, my God, it's eat or be eaten. It's a very different mindset. All of a sudden you start saying, I'm exposed. On the other hand, there were positive developments from the point of view of people that wanted to make a gazillion dollars, which I'm not putting down. And that is in 1982, the US stock market began an 18-year bull run, the likes of which I don't think had ever been seen before. And specifically from the point of view of top managements, like a meteor in the sky, the Gibson Greetings LBO provided a 66-for-1 return in 18 months to the private equity sponsor, Westray, and the management. of gifts and greetings. And all of a sudden, we were off to the races. People realized that adroit management of your corporate governance situation and takeover times could generate huge returns to anyone who was smart and aggressive enough. So as we started having lots of LBOs, what happened to the attitudes of the typical top managers? Well, first of all, their sensitivity to debt levels started to go way down. They started viewing debt, instead of being a threat to the kingdom, as being a great source of potential leverage and power to them personally. And they started expecting huge upsides to the top executives. On the other hand, with the hostile takeovers, they were, as I suggested before, increasingly concerned about their personal exposures if they weren't protected contractually and if they didn't manage to make money off of this trend. As they were getting more concerned about their own downside and upside, their concern over the traditional constituencies dropped way down. You know, somehow those people will take care of themselves. I'm to worry about number one. So what happens in the 80s, the top managements begin to push for greater company profits, even at much greater risk to the long-term enterprise, and greater personal shares of those profits. So there's an internal push to get people to make money for you. There's also an external push where where top management started pressuring gatekeepers and by gatekeepers I mean the reputational intermediaries like accountants, outside counsel, and boards, to be able to go along with the new image of the company that the CEO now wanted, where the accountants were pressured to show more profits and less debt than economic reality would suggest was appropriate. The lawyers to bless decreasingly truthful public disclosures. And the board committees, composition committees, were not pressured but manipulated into giving big increases in CEO upside. So what you have is sort of like a positive feedback, self-perpetuating management cultural loop where you start out with changes in top management preferences as a result of the LBO, risk and return, starting to say, geez, I might be eaten. Well, I'm going to eat somebody, I'm going to make a lot of money doing it. So then they start pressuring subordinates for better company results. Presto change-o, better company results, warranted or not, start appearing. The board, a grateful board, rewards the CEO with large stock option package, and it gets more and more intense each time as the pressures, internal and external, become more and more, egregious as the stakes rise. So as we have this pressure cooker developing, what happens? Concern for legitimate interests of other parties in business relationships declined. Concern for the long-term decline. Well, if you can understand that, if you can make $100 million in one transaction, who cares about the long term? The trust and trustworthiness among the various players declined, excluding boards, which in their sleepy, docile way didn't know what was going on somehow. And worse, the regulators descended into a dogmatic slumber, just as they were needed more and more, as they increasingly trusted managements and gatekeepers to actually do the right thing as they were becoming less trustworthy. So in effect, you might say the baby was thrown out with the bathwater. What do I mean by that? Well, the constraints that were jettisoned in this new world included not only what I call technical constraints, cramped old business traditions, stifling group conformity pressures, things that really don't make a lot of sense, industry, sort of common sense, which often is wrong, but also ethical norms. So throwing out things that I don't think really matter, like received wisdom, together with things I think do, which are ethical norms. So the old CEO question, how can I achieve reasonable profitability, not maximum profitability, but reasonable profitability while honoring my obligations to my various constituencies? not an ethic of maximum efficiency for sure. But certainly in my judgment, better than the new CEO question was, how can I exploit the situation to help achieve my net worth goals with acceptable personal or legal risk? And that's exactly the change that occurred between about 1975 and 1990. So starting to turn to Enron, thinking, as Enron looked at its industry, which is the pipeline industry, what did it see? It saw slow growth, stable competitive hierarchy, company strategies focused on minimizing risk, and acceptance of regulation. And it basically opposed all of those characteristics, which actually does make sense to me. They would try to break out of these somewhat self-imposed sort of boxes. What were the norms that it was so disdainful of? Well, it was disdainful of people not seeking to maximize profits. I understand that point of view within limits. It was disdainful of people balancing competing interests, workers, customers, shareholders, local communities. It was disdainful of anyone who was loyal to traditional gatekeepers. It was dismissive of people protecting long-term company reputations, and it was quite unconcerned about the long-term health of the company. So it basically took everything in its situation and threw it out. The next, I thought about whether I should include this slide. I'm going to give it a shot. Is it worth? I think I'll give it a 2-minute shot here. If you look at how companies commit fraud, there are 2 basic ways to do it. One way, which is the WorldCom way, you have accurate financials at the lower level, the division level. Then you have top-level fraudulent adjustments. The Enron way, all of the transactions over wide parts of the company by widely disparate players were all distorted, and then there was no necessity for a top-level fraudulent adjustment because they had hired people with the right malleable ethical standards and the right incentives to basically do all the fraud for them. So sometimes, and that's where a lot of the mark-to-market comes from, where basically Enron, a lot of different players in Enron with similar incentives and similar ethical principles or lack thereof would take assets and then mark up their market value, recognize the income whenever they wanted a little extra income. And that was typical. So top management would say, how aggressive do we have to be this quarter? And people would just come up with bullshit numbers to be able to achieve what top management wanted. On top of that, which was sort of an ongoing sort of approach where people would game the numbers, whenever it came to major, this is the second bullet, whenever it came to major transactions, Enron's outside lawyers and accountants would optimize the disclosure. And what does that really mean? It means that for a given economic reality, you attempt to generate the highest amount of earnings and lowest amount of disclosure of risk that you can. So between the ongoing gaming of asset valuations and the episodic huge transactions in which the economic realities were belied by the accounting, Enron basically used the rules of GAAP, generally accepted accounting principles, to gut the economic substance of GAAP, which is to show fairly the results of a company's operations in a given year or quarter and its financial situation. But there are weaknesses. Every decision in life has consequences. What were the consequences? The weaknesses where the top management, having tried to merely lie to outsiders, couldn't figure out where the truth was itself, where are real economic profits being made, which segments have the best risk-return relationships, what's our true debt capacity. They didn't know any of these. What they started to do is to believe their own bullshit. And that's when you really end up getting, that's when your whole survival is threatened, when the lies you attempt to project onto others come back to haunt you. Oh my God, what sort of attitudes would generate this type of approach to business? Well, in the case of skilling, it was sort of an Ubermensch mentality, where ethics is the attempt of the weak man to bind the strong man. And he rejected all traditional boundaries, unacceptable business practices as being the sort of constraints that he would not allow to be imposed on him or his organization. One of the things that especially invites exploitation are information asymmetries. What is trust? Trust really in a lot of ways is the willingness to accept information asymmetries with certain people that you designate as being those that where you will take the risk that they won't exploit the information asymmetries. There are other ways that trust can work, but this is one of them. So in other words, one of the groups that was worth exploiting were board members, so that so top management would routinely dissemble with the board and encourage the board to help management dissemble with outside shareholders. But the main point is that outsider trust is just another source of attractive asymmetries, and social trust is the ultimate commons to be exploited by the strong man. Lay had a different view, less explicitly immoral, and that is, but it's sort of almost a comical version of sort of the Austrian school, and that he quite literally believed that individuals spontaneously coalesce in productive economic aggregates, both in society and in corporations. So there's really no need for centralized control in a corporation. There's no need for social norms. Somehow the magic of the market will work to create value within a company. Of course, the question is, what was he doing? Why was he paid all the money he was paid since he didn't do anything? Well, I think his answer would be he steered the company into the right strategic areas, and he hired the right people. Well, what he hired was, the person he really hired and pushed was Jeff Skilling, who then populated the whole group of people in the company with people of equivalent intelligence and lack of ethics. The other people that are worth mentioning in terms of the attitudes which were crucial are the outside lawyers and accountants. And just as there are ethical requirements that managements really start to ignore at their peril, that's also true of lawyers and accountants. The securities laws and GAAP have provided us with capital markets, which are the marvel of the world, and one of the reasons why we've been so successful allocating huge amounts of capital, attracting outside capital to the United States. But they're constantly at risk because you can use the securities laws, the details of the securities laws, and the details of GAAP to gut their spirit. You can use the actual letter to gut the law. And the attitude of the outside lawyers and accountants was that there were no moral norms embedded in these laws, nothing of importance, just a series of games, and some people are better at disclosure games than others. These ethical constraints where people say, no, I'm not going to tell a lie, were replaced by risk-return assessments. So instead of having bad accounting and good accounting, you have high-risk accounting and low-risk accounting. So basically, again, the ethical constraints, which are somewhat inflexible, start being replaced by much more flexible personal risk return assessments. And so as a result, there was no concern at all for the substance of accounting and legal rules, no concern at all for the impact on people of poor disclosure, no concern about lying. So what was unimportant to the co-conspirators, I call them? The legitimate interests of other parties, fiduciary duties specifically, where top management owes a duty of candor and loyalty to the shareholders, concern for the long-term good of the business. Of course, that was old-fashioned. And any moral claims embedded in the substance of securities laws, that was all thrown out. What was high in importance was exploiting asymmetries in every business relationship, and especially from Skilling's point of view, defeating all the constraints arising from legal and accounting rules that bind lesser individuals. So what were the results of all this? Well, again, in a longer presentation, I could go through the techniques they used, but basically, they obscured the true economic risks and returns of almost all their assets by the various accounting devices and artifices they used. So as a result, top management decision makers systematically underestimated the risk of their business and the resultant importance of improving their capital structure, which ultimately led to their demise. The other problem was they couldn't figure out, where do we put our money? How can you figure out where do you put your money? In a well-run business, you put it where you think you have high returns and low risk. But in their case, they put it where they had high reported accounting earnings and low apparent accounting risk. But those had nothing to do with what the economic realities were as a result of their own efforts. So it's as if they got so embedded in their own fictions, they forgot they were fictions. What were the results for operations? Well, basically, every major company requires intra-firm cooperation to exist. And every major company that has any physical operations needs good operating people to make sure things work, the pipeline runs, it doesn't blow up like one just blew up today or yesterday, that they actually do what they're supposed to do. But the status of operating people who actually were just doing a good job was very low. The status of people who could actually say, oh, that $100 asset is now worth $1,000 because I say it is. Their status was very high. So where do you start pushing the bonuses? Do you push it to the person who keeps the pipeline running? Or do you push it to the person who says that the $100 asset's worth $1,000? And that's the person they started to promote, and that's the person they started to actually say, this is our ideal. So gradually over time, you have fewer and fewer real assets and more stuff that dreams are made of. There are also effects on people, employees as people. Not only were they uncooperative with other similarly situated people, but they are often deceitful in dealings with other employees and with management. And I think there are two reasons for that. One is that employees, I think like children, including me when I was a child, look at what adults do rather than what they say. And so when people signal certain things as being important, employees pick up on that. So if employees see that the top management's lying to outsiders, then they'll say, okay, I understand the rules. Okay, I'm happy with that. So they start playing by those rules. May not be happily playing by those rules, but they play by them. So as Enron employees saw how Enron top management engaged in complete bullshit fictions, they started doing the same. The other thing that Enron had was a rank and yank system where the bottom 10 or 15% of the people had to be disposed of every year. And so, in the right human environment, like say McKinsey, you might be able to make that work, where But if you take people who are already hyper-competitive, chosen to have very little in the way of ethics, and whatever ethics they have are sort of gradually deformed out of them, and then put them in a rank and yank situation, what they'll do is actively torpedo each other's deals. And quite literally, they'll corrupt each other's data, they'll ruin each other's businesses to be able to get one up over someone else who's similarly situated. So the results of all this were systemic inefficiencies and deeply unhappy people. One of the things, I used to have to give talks on Enron, and I finally told my professor friends, I'm not going to do it anymore unless I can talk about positive polls, because first of all, it's such a nightmarish part of, I don't even like thinking about Enron anymore. But also because unless one is convinced that there's not just negativity in life, there are positive alternatives. What good does it do to talk about the negative, really? So my last job, after I left Enron, after I, the general counsel, and the controller all left Enron, our subsidiary of Enron, which was never disclosed by Enron, I helped a friend start a company called Spinnaker Exploration, which was engaged mostly in natural gas exploration in the Gulf of Mexico. 1996, we got about $100 million in cash and something called 3D seismic data, which is a type of information on the indirect information about the subsurface that helps direct oil and gas exploration. Anyway, we got about $100 million in cash and seismic data commitments from a private equity firm called Warburg Pincus and from Petroleum Geoservices, our Norwegian seismic data company. Stock at the time of formation and beginning of 1996 worth about $5, sold out about 9 years later for $65. Everyone that signed on at the start, in the first 6 months, I'm happy to say, ended up a millionaire. And everything we promised to our employees and to our shareholders, we exceeded, which was, that's at least very important to me, because so many people make money the wrong way, but it's possible to make lots of money by the standards of 99% of the world with doing the right thing, and I think that's been forgotten in our society by so many people, and it's personally very worrisome to me. We had some articles of faith, very simple. The best information will attract the best people, but information without honest communication is useless, and you won't get honest communication by your employees without honesty at the top management level. Short-term gains based on exploitation or abuse of the trust of stakeholders may be helpful in the short term. In the long term, they will be fatal. And it is never worth doing to abuse the trust of anyone that you're in business with. We expected that if we picked the right employees who had not already been ruined by other devious or mendacious employers, that they would respond to the right just treatment, and that was also accurate. Finally, when you start a company, you think you know what you're going to encounter, but much like what Mike Tyson used to say of his opponents, everyone has a plan until they get hit. Reality hits you with surprises and reversals, and every startup always has this problem. Some of your fundamental assumptions don't work out. What do you do? Well, in our case, we had a simple solution a lot of times. Quite literally, we'd ask ourselves, what would Enron do? And we would do the reverse. And I'll try to speed it up a little bit because I don't want to take too long, but basically, we handled truth, the reverse of Enron. So in the case of Enron, truth is a valuable commodity which you want to hoard. You don't want to share for free with anyone, because that would be a bad trade. You want to be able to give them what's of least value to yourself and get from them what's of greatest value. In our case, we believe lying breaks down relationships, and that the loss from those broken relationships far exceeds far exceeds any short-term benefits of withholding truth. We also believe that organizations start out lying to others strategically and end up lying to themselves all the time. And finally, and this ties back to operations, if you have a problem with operations and you can lie about it, you tend not to have the same incentives to fix the operating problem. Telling the truth focuses the organization on how to best solve major problems, not how to cover them up. So we would be quite open with our shareholders. Here's the problem, and here's how we're going to fix it. So we didn't say, here's the problem, and we have no idea what we're doing. We wouldn't dissemble about the fact we had a problem. We'd say, here's the problem, here's how we're going to fix it, and we'll get back to you. And that generated a set of very devoted stockholders who were used to us under-promising and over-performing. So in effect, what we would do is, and there's always a bit of, one of the problems that I won't be able to get into, but a real problem is that if you're in any company and you're trying to address stockholders, you will know far more than any of them will about your company. As a matter of fact, a lot of them are unable to really understand sophisticated analyses of what the issues are. So you always end up summarizing in ways that distort the true reality, because a truly nuanced presentation would go way over the heads of most people who are actually buying securities for you all as you get older, and which is another issue, but we can't address. So what we intend to do is project mediocrity externally and demand excellence internally, but we would never disguise what our problems were. And I'll summarize this in just two sentences. Enron viewed the laws as basically something to be exploited, and at Spinnaker we viewed the laws as something to which we should adhere in letter and spirit. And what people forget is you expect to be able to strategically manipulate your way through all the laws that bind society and that expect that others will act in a lawful way with you, and it just doesn't work that way. And rather than go through all this, I just say that Spinnaker did view profit maximization as a legitimate criterion, but within ethical constraints, and Enron viewed profit maximization as the only standard, and that there are no constraints which should ever be imposed on profit maximization. So unlike traditional public companies, which had ethical constraints, but what also had what I call technical constraints, there's probably a better phrase for it, those accumulated burdens of past thinking which don't relate to ensuring that your interactions with other individuals are informed and voluntary, but really relate to industry common sense, accepted ways of thinking, business tradition, or simple group conformity. They would also have been suffered from those constraints, which I think are dispensable. Enron got rid of both, and Spinnaker was an attempt to be able to honor traditional ethical constraints, but not follow accepted industry traditional thinking, which I believe was counter to efficiency. And actually, I'm going to skip over that because I have lagniappe, for whatever it's worth, because I can never, and that is one of the things I'm absolutely convinced of is that people who work for value-producing companies, assuming we're not talking about not-for-profits, but let's talk about the for-profit sector. If you're working for value-producing companies which are trying to create value both for themselves and their customers, you'll be a lot happier. Now, that's not true of psychopaths. I'm quite serious here. 3 to 4% of the population are psychopaths. And for them, working for a value-producing customer is not actually as much fun as working for something that exploits trust and does evil things. But for the rest of us, you, at your own psychic peril, do you start to adjust to evil? Because unless it really comes naturally, you'll never be happy doing evil things. And that's important, because what can happen in life is that you find yourself in your 30s and 40s, and all of a sudden you realize that you're even more of a compromised, mediocre creature than your parents were. And when you're in your 20s, you have grand visions, and they can get lost. It's easy to get lost. I think that what Enron looked for, well, they looked for the smartest people, but they wanted young people. They didn't want people like me. I was a mistake. They wanted young, really smart people, because I don't know what the right term is. I call it ethical neuroplasticity. Young people's ethics can be deformed under pressure, and it can be deformed in ways that are very advantageous to evil corporations. So the way, at least my advice for what it's worth, is to treat your first job as a way to investigate your chosen industry, to look for the right organization that doesn't just mouth the right things, that everyone mouths the right things, that actually tries to do the right things by their customers and constituencies, because you'll be a lot happier in those. So that means you may have to jump after a few years, but they're worth looking for. They're unlike, say, pre-75, when maybe the majority of companies really were ethical. I think it's a very small percentage, but that's not the same as zero. So like cheap stocks, they're hard to find, but they're worth the effort of discovery. And that you really, that's the way to reconcile, I believe, a happy life with an economically productive life. And that's getting in with a company that does the right thing, which I believe will outcompete other companies over the long haul, and have happier people. And to my way of thinking, at least, it's not the amount of money you make that really makes intuitive sense to me. It's how happy you are. And there is a disjunction which Americans don't seem to buy into. Anyway, so that's it. I don't know if there are any questions, but I guess it's all self-evident.
Thank you very much.
As someone who's involved in the pipeline industry, how do you...
Sorry. Introduce yourself and make the question.
My name is John Rosbergs. I'm a senior economics major, and as someone who's experienced in the pipeline industry, how do you feel now about the current conflict in North Dakota and Standing Rock?
It was easier 20 years ago when, first of all, it was a different world in terms of looking at how hydrocarbon intensive economies should be. We were mostly looking for natural gas. I'm probably not quite as moralistic as some people are about the necessity of eliminating all hydrocarbons, but I would say that I really do believe we should have a carbon tax, and I would say that we should also work hard at reducing the international price for oil, and as a gradual measure to remove oil to the extent possible. Now, part of that is because I don't really want to feed Saudi Arabia's unique approach to the good society. I'm probably better not to just, but anyway, let's not go into that. But anyway, so as a general matter, I like the idea of being able to decrease the prevalence of oil production in our energy base, I probably am more interested in trying to come up with incentives to do so rather than actually trying to have the brute force of forbidding pipelines. That is it.
Hi, Peter Henkel, studying a master's at the School of Management. This is more a general and broader question, just revolving around boards and the morals and ethics that go along with that. And it seems to be quite prevalent within Enron. We now have the Wells Fargo saga going on at the moment, where the boards and certainly senior execs always claim to know absolutely nothing about what was going on.
Boards is probably accurate. In other words, though, if someone doesn't want to know, are they still morally guilty?
Exactly. So you have two issues at hand here. You actually have the ethical side of them saying to their employees, we need to increase our bottom line, go and do it, and we don't mind how you do that. The second one is the actual ethical and moral side of when it does happen, they put their hands up in the air and they deny it. So the question revolves around how do you then actually structure your board and how do you mitigate those factors and actually make the board responsible for everything that goes on underneath them?
Well, that's an excellent question. It'd be interesting if it won't happen as long as we have divided government. But if we had a situation where you actually had the Elizabeth Warren's forces in the ascendancy, where basically just as the Tea Party Republicans, I think, are dominating the Republican policies, maybe Elizabeth Warren's faction, if the Democrats get control of both the House and the Senate, would be able to dominate, in which case what I'm about to say might actually happen. And that is that the only way I can see that boards would actually start to do their job would be if they were actually chosen at random and not based upon relationships that the CEO has. So there would be, groups of people who were viewed as eligible for board memberships, and literally it would be a random sort of selection, much like, the only way to get decent accounting would be if there was a random selection of accounting firms. That's an incredibly radical shift. You'd have to override, you'd have to basically start having federal corporation law, which actually the SEC was debating about 50 years ago and never got any headway. But actually, in spite of the fact that I'm, within New Haven, very far right of center, in this one regard, I'm not. And that is that I don't believe the private sector can actually get its act together to be able to have real boards of directors who actually try to do the right thing with under the current system, which basically perpetuates the insider interests of the CEO. There is a tremendous culture of go along, get along. It's almost a form of rudeness to ask a tough question. And so you have to overcome a huge amount of board inertia. It's not as if they know what it's not a form of conscious parallelism, it's unconscious parallelism. People just don't even have to think about what the rules are because they've been absorbed so far down.
I don't know what it's like in the States. I'll just speak from South Africa in particular, but they basically now instituted corporate laws that say that if anything goes wrong within the company and if there's any fraud or transactions that are unethical or unmoral or just fraudulent, the board is responsible. End of story. And what it does now is it puts all of the emphasis onto the board members and the CEO and the chairman and the people that are governing that company to say, if we don't look into all these matters and if we don't make sure everything is fine, we're the ones that are going to jail.
We haven't gone that far, but the fact is even the laws we do have not been pursued with sufficient rigor that there are the sort of disincentives that truly economic men need to be able to adjust their behavior. In the case of Enron, for example, the only amounts the board paid out of pocket beyond what they were reimbursed by the insurers for was 10% of their ill-gotten gains on their exercise of options in the last several years. So one of the great concerns I have is that until there starts to be greater certainty of huge economic loss, if not jail time, for people that don't do their affirmative duty to investigate, this is just going to keep happening over and over again. It may take another 10 or 15 years, but it's going to happen. One of my great disappointments and my concerns from the last financial crisis is we've never gotten a clear answer, maybe it occurred and I didn't hear it, as between two possible reasons why no one was ever jailed from top management. A, that the laws don't extend to their skullduggery, and you can be hugely abusively unethical but with impunity, or that their actions did extend to the point where they should have actually been tried, but people pulled back from the precipice because they didn't want to take on some of these powerful people. Either one would be something that I'd really like to know the answer of. But it's certainly, one thing I do know, and that is for the people that I used to know in finance, unless you either go to jail, doesn't have to be a medium security jail, that would really help, unless you either go to jail or else you pay personally out of pocket, unreimbursed by anyone, huge amounts of your net worth, you're not going to adjust your behavior.
Hi, Nick Sellinger, I'm a senior chemical engineering major. You talked about how from the 1970s onward there was the shift away from like the values-based corporate culture. I was wondering if you think that like hit a bottom at some point, or if
That's a good question.
It's like
That's a good
improving
question.
now, if the 2008 crash like had an effect on that at all?
You know, that's the limitation. I would have known the answer in 2006. I knew the answer in 2006. I'm not sure what the answer is now, to be honest. In 2006, I knew the answer. The answer was things had not bottomed. And that's why I went around, I looked for the right hedge fund manager to help me short the US financial system, because I was convinced that, that you cannot base a financial system on a tissue of lies, and that's what I saw all around me when I looked at some of the people that I'd known in investment banking and commercial banking, and some of the worst people imaginable running some of the most powerful companies imaginable. So I knew the answer then. I do know what they're saying now, which is that the company is ruining their business. So it makes me feel somewhat better about what's going on, you know, because if they were feeling comfortable, I would feel very uncomfortable. But they're complaining about how the government's ruining their business, and it's no fun anymore, which makes me feel like we have an extra 10 or 15 years before the next financial crisis. And if you look back at the history of the United States, basically we had financial crises about every 15 years between, during the 19th century and all the way up to the SEC, the New Deal changes. I expect that unless, and I'm really not a Democrat, but I expect unless that you have the Democrats running things, which will have their own costs, that we'll be back to that every 15, 20 year type of sequence, because people forget the lessons of the past. And what happens is that recedes into memory. That's an older generation's memory, not your generation. We're a new generation with new ideas. We'll handle this well. And actually the stability that you get after the government imposes new regulations starts to lull people into a quietude about the probability of yet another crisis when those restrictions are released. And so I'm expecting that cycle to continue. Only I expect that it probably could get worse and worse, because as we become more and more a financialized society, unless manufacturing returns to this society, will be more and more in the thrall of these big financial companies. So when they go proper, which I think will happen again, then all of us will be much more threatened than we were last time.
Hi, I'm Caitlin Kiker. I'm a junior studying computer science and psychology. When you're looking to hire ethical people or people with integrity, how do you assess their morality in that short amount of time during the interview and hiring process? Like, how are you ensuring you're getting those type of people that you want?
Well, it's the right question. I'm sure there are probably techniques for companies that hire thousands of people, which I didn't have to worry about. I was just the CFO at Spinnaker, but it was a small company, 50 people. So when you have a small company, you can find out about people from your friends. Because Houston was the center of the world energy business, it still really is. But it's a small enough town where you can find out what people think of certain individuals, whether they're people of their word, whether they're reliable in tough situations or not. In bigger, I would admit it's a real issue in larger companies, and I don't know the answer, but we made sure we hired people who had not been ruined by past employers. So some people, when they're in extremely hostile work environments or diseased work environments, basically lose their ability to believe in anything. So life becomes a game. It's all a game, nothing matters. It's all bullshit. And so for people like that, they're so far gone, you couldn't do, even if you did the right thing, it wouldn't do any good. So you have to find people that still are viewed as solid citizens that care, that actually tell the truth. And that's what we look for. But it was easier because we had a small company.
Is that rare? Like, the way you're talking about it makes it seem like that there are a lot of people that are unethical. Like, is it a hard?
Yeah, there are. I mean, but it's not zero. In other words, it's not like ethical people used to be prevalent. Let's say up to about the mid-70s. Now they're the minority, but that's not the same as zero. What it says is that everyone talks a great game. Not many people play it, by which I mean everyone acts like, oh, we care about our customers, we care about telling the truth. Well, for the majority of companies, that's bullshit. But the fact is that's why I was saying your first job, if you go to the wrong company, then that's okay. You can't worry about it. Everyone makes mistakes. It turned out it didn't work. So you find out, you use that as a basis for finding out who really is doing the right things by their customers. And that company is worth working for. A lot of really, when I was at Lehman, which was a really nasty place, we used to be able to get people for an extra $5,000 or $10,000. Well, don't get trapped. The other point would be, don't get trapped where it's worth $5,000 or $10,000 extra dollars to work with a group of really bad people, because that extra money you're not going to be happier with the extra money. You may drink it away, you may go to fancy restaurants, but at the end of the day, you won't be happier working for people like that. Now, I did for a while. I trudged through life, but I had no idea about what was going on. It's only in retrospect where I'm able to sort of think through that I could see what was happening and came up to my own conclusions about what really is important in life, because I had no idea. It's a luxury to be able to think through. Life hits you, it's so hard and it comes so fast at you. What's going on? The other thing that actually was in my talk, but I forgot to mention, that's really important to me. If you have someone who is, let's say, doesn't have a lot of options in life, maybe didn't go to a great school, doesn't have any money, well, you threaten them. But suppose you have someone who has lots of options in life, really smart. What do? What you try to do is you try to change them into what you want. And the typical way you do that is by telling them, you don't realize that this is the way life is? You're naive. Get with the program. What's wrong? You don't realize this? So you try to shame them to make them think that they're intellectually naive and they're not sophisticated. And gradually you can turn them to whatever you want. And part of what I'm trying to say is people will try to convince you this is the way life is. No, it's not the way life is. It's the way they are. Having said that, it's the way more and more people have become in our society over the last 40 years, so you have to look hard to find the right people. Don't expect that you'll get it the first time. And if you get the wrong people, don't hold it against yourself. Fool me once, okay, well, I'll figure some way to do it. But it's a bunch of things, but they'll try to work on you that way, and that's any smart company will do that to really smart people, young people. Don't be so naive.
Yeah, I'm Henry. I'm a senior econ major. You mentioned short selling, and I just wanted to ask you about what role you think short sellers are playing and will play in exposing the next Enrons, and do you think shorting in itself is morally acceptable?
I think it's morally acceptable because I think that they're necessary to puncture the bullshit of the people who are long. I mean, if I look at the people, the short sellers, they're the only ones who really knew much about most of the companies. Most people who are long, who are basically working in the mutual fund business, really have no idea what they're buying. That's one of the problems I had, trying to figure out how do we express our prospects at Spinnaker to people who really have no idea. They're investing the public's money and they have no idea what they're buying. So, short sellers really have to know what they're doing. Now, is it possible for a short seller to be immoral? Yes, if they were spreading lies, that would be immoral. But what if you really believe your own analysis, which I believe someone like Jim Chanos would? If you believed your analysis and it was good analysis, then I think they're doing the absolute right thing in terms of being able to prevent lies from being able to dictate the capital markets. One of the most concern I have about China is that they're not used to people like this. And that's, if I had to pick the place where I expect the next financial panic to come from, it'll be from China. It was very advantageous for us that they were hermetically sealed off from our capital markets as they start to sort of coalesce. Unless they're also changing their attitudes toward the importance of truth-telling and the benefit of people like short sellers, I think we're all really exposed to that in the next 10 or 15 years.
Hello, I'm David. I'm a senior majoring in economics and finance, and I'm just curious. Milton Friedman defined a firm as an economic unit that maximizes profit given the legal framework. How do you think this definition has changed over time, and what would your definition of a firm be?
Definition of what?
Of a firm, of what a firm is.
A definition of a firm? Yes. And how's what changed? Say that again. Let me just. It's a personal detail, but I had open heart surgery a few months ago.
Yes.
One of the products of open heart surgery is a certain amount of cognitive impairment. One of the features, quite literally, is that in addition to being unable to filter out ambient noise, if someone has any different type of accent from my own, I literally have trouble understanding. So can you restate slowly what you asked? My apologies.
Yes. So Milton Friedman defined a firm as an economic unit that maximizes profit given the legal framework.
Yeah.
How do you think that definition has changed over time?
The situation, I believe, at least if you compare, I can't remember which of his writings it came from, but let's assume it came from the mid-'60s. He was writing at a time when the government really did make the rules, and where there was a lot less private sector power to be able to manipulate the rules to their own benefit. At the time he wrote that, I would have been much more comfortable with that notion of all a private sector firm has to do is to maximize profits, to be able to look at itself in the mirror, you might say. At this point, since I believe a lot of very powerful private sector players are having, if anything, too intrusive an impact on the rules, I'm being much more concerned about profit maximization within the context of rules that I came up with as a result of my pressure, even if it happens to be nominally legal on the legislative system. So having said that, if the way I do look at, the morality of what we were trying to do is I looked at every transaction that was voluntary and fully informed as being ethical. But the problem is this, and that is that in the imaginary world that at least I see populated in a lot of economists, each person is fully informed. Each person is able to assess with lightning speed all possible future states of nature and be able to optimize the results. That's not real life. Real life is that we don't have the time to be able to figure most things out. We don't have the time to be able to go through all the boilerplate that we all sign up on whenever we're on the internet. So I have a different point of view as to an extra, you might say an extra sort of concern, and that is that, or a wrinkle, and that is where it is impossible for the counterparty to be fully informed, either because of their lack of intelligence or lack of time or both, I have to feel, I have to believe that my interaction with them, my transaction with them is in their long-term best interest. And that's the extra element that, because in our case, for example, ideally we would have been able to, for example, have some sort of graph which would have shown what our expected production was for the following fiscal year, and assuming other equivalent sorts of expectations, people could get to an expected cash flow per share. But the point is, but for the people buying our stock, they would never look at that. They instead would say, just tell us what you're going to earn. They were unable to handle the extra facts that I would have been happy to give them. They would have been irritated that I even tried to tell them. So at that point, what do we have to do? We have to be able to come up with guidance, and we have to come up with disclosures that I believe will make them do the right thing in terms of either buying the stock or holding. But their lack of information was a permanent bar to being able to have the world that Milton Friedman envisioned.
Thank you.
Hi, I'm Lexi. I'm a senior majoring in economics and Spanish. And my question kind of stems from the fact that probably a lot of us in here are going to work at either investment banks, hedge funds, financial institutions. And I was wondering if you have any advice or thoughts on what you think we should do if we see people in senior management roles being unethical, or if we see corruption from such a junior level. What would you suggest doing? Going to find another job, or
that's
saying
really
something?
Yeah, that's really what my advice was the using your entree to the industry as a basis for looking for the right company. Maybe a braver person, like my father and uncle, both highly decorated war veterans. They might charge that hill, but I didn't have that in me. I had the ability to abstract myself from the worst situations, but I didn't have the ability to go to the authorities. Now, one of the options would be go to the authorities. Of course, at that point, if you're wrong, you are eviscerated. Not just, and not just if you have a Donald Trump running the firm, but anybody. These people at the top shoot real bullets. So my advice, but it really is very much the way I've handled life, for better or worse. I'm not claiming I'm doing the right things. I'm just saying, here's what I did, and you can decide. My advice would be to not accept situations where there is a consistent tendency to do the wrong thing. Most organizations occasionally do the wrong thing. And if you're perfectionistic, you say, well, I won't be associated with any organization that ever does the wrong thing in any transaction with anyone. Well, in that case, it's very simple. You should, probably, go to a monastery or wherever. But looking for consistency, are we consistently indifferent to the interests of our counterparties? Are our counterparties equivalently located individuals and other, so if you're in a trading desk and you're dealing with other trading desks, in my case at least, I say, well, okay, all right, they're dealing with adults. Or are they dealing with people that really are trusting them to do the right thing and then they're doing the wrong thing? That's the type of thing. So if they're doing the right thing, but occasionally fail, that's a good company. If they're consistently doing the wrong thing and don't seem to give a shit, then I say it's the wrong company. But rather than try to sacrifice yourself unnecessarily, I would say find the right company and move there.
Hi, my name's Colleen. I'm a senior economics major. During the financial crisis, a lot of the rating agencies claimed freedom of speech in their core ratings of a lot of securities. And I was wondering what your thoughts on the line between freedom of speech and fraud and maybe thinking something's true even though it's not true.
Yeah. Well, I haven't, the rating agencies, I haven't really listened to for a long time. I've always thought they were very good at looking backwards and not looking forwards. I thought their arguments were very adroit for a right-wing Supreme Court that would, for whom freedom of speech is eliminates all other thought. It's obviously commercial speech, made them a lot of money. I believe that they either knew or should have known with any reasonable investigation that it was bullshit, and they got away with it. And that's one of the reasons why I think that that we're still at risk in this country, is that people got away with stuff with impunity. And for the type of person that I've identified, for whom only risk-return analyses are available, all they care about is the money and maybe going to jail. But if no one goes to jail and no one pays personally money because of either indemnification or D&O insurance, hey, why should I do anything different? And so I would lump them in with the group that really is a threat to our future because they didn't pay a price of any real significance in my view.
So thank you very much indeed.